My biggest concern is inflation. My biggest concern is there is let's give it a small chance, the Reserve Bank will have to do what they did in 2008. They threw the economy into recession in order to get inflation under control. People often talk about during the GFC, the global financial crisis in New Zealand, house prices fell. They fell by about 11%, and then the conversation moves on.
Welcome back to Tea with Tony, our last for the year and our fourth and hopefully final remote COVID instalment. It'll be nice to see you again, Tony, in person. At the time of filming, the country is on the eve of moving to the new traffic light system. And in keeping with that theme, we're red for inflation, red for interest rates, and it's looking red for first-time buyers. But for the first time in the history of this segment, there are finally indications of the housing market turning. So where does that leave us all economically? Red, yellow or green? Let's get Tony's view. Hi Tony, how are you?
Great, Lenska. Great to be back again.
I want to start with the housing market today because I know you've got some hot off the press survey results you're going to discuss with us, and those results suggest a weakening in the housing market, which is a first for this segment, as I said. So let's chat us through your findings.
Okay, so basically since April last year, when we were just into the nationwide lockdown for the first time, I started up a survey of real estate agents all around the country, and I've been doing it with REI and Z ever since about May or June last year. I asked the agents, are you seeing more or fewer first home buyers, investors? Are you seeing FOMO, fear of missing out? Do you think prices are rising in your location? And so I can gauge right at the coalface what is happening in the real estate sector well before the data ever come out on house prices and these sort of things. And so what I've found over the past week when I've been running the survey is things have changed fairly radically. If we look, for instance, at the net proportion of agents saying they're seeing more or fewer first home buyers, last month a net 2% said, slightly fewer first home buyers. Now we've got about a net 56% saying definitely fewer first home buyers there. Also more of a stepping back from the investors, but they mainly already did that after the March 23 tax announcement. And I guess the measure I focus on most of all, because it's the only one available in the country like it, is the FOMO, the fear of missing out. April last year, 35% of agents said they could see FOMO in the part of buyers. They were edgy, wanted to make a purchase. Between August and February, August last year, February this year, that was running up to 90%. So absolute frenzy. Fell to 49% just after the March tax changes there. For recent months, 70%. Now we're at 39%. So the FOMO is almost back to where it was in the first nationwide lockdown. So the markets have basically taken a big breather just over the past 3 weeks or so.
We're seeing a bit of that reflected in our business as well in terms of volumes, and we're putting that down to a number of factors which we're going to talk about in a minute. So what are the key drivers here, Tony? I know it's early days and this is very new survey results, but you must have an idea of, and I think everyone will have an idea because it's not rocket science, what's driving that final shift that we've been talking about for, I think, probably 6 months.
Yep. There's a few things in play. I mean, this is the way it goes in markets. You're chugging along, one thing happens, maybe another thing happens, and then all of a sudden lots of things happen at the same time, and that's what's happened in the housing market. And in particular, I mean, certainly we can focus on interest rates have gone up. Mortgage interest rates have gone up between 1.2 and almost 2% from where they were 6 to 7 months ago. And ever since fixed interest rates appeared in New Zealand in about 1991, this is the fastest pace of increase we have ever seen. Even with the Reserve Bank only increasing its cash rate 0.5%, the markets are anticipating the Reserve Bank next year will go bang, regularly increase interest rates. that gets factored into the medium-term costs that banks have to pay to borrow to lend to you and I are fixed. So yeah, the fixed interest rates have already shot up, and that's going to be maybe the strongest restraining factor over the next 2 years. But it's not the big factor at the moment. What's happening is that there's a bit of a credit crunch underway from the banks, essentially, for 3 reasons. Number one, from December 1, banks have to meet new requirements of the Credit Contracts and Consumers Finance Act, CCCFA. Basically, it means the banks have to apply the most stringent assessment of people's expenses, income stability that we have ever had in New Zealand. And the banks are a bit uncertain about what to do at the moment. So they've erred on the side of, we don't want to make a mistake. We have to prove exactly what we've done. And so they've tightened up more than I think will be the case a few months down the track. But that's definitely
Tony.
yeah, definitely restricted the credit out there. But that's only the first thing. Secondly, from November 1, banks can only have a maximum 10% of their new lending where the deposit is less than 20%. Early in November, the lending growth was still fairly strong. And at some point, it looks like towards the middle of November, the banks went, oh my goodness, if we continue as we've been going, we're going to breach the 10%. And the last thing a bank ever wants to do is breach one of the Reserve Bank's requirement. So they've just shut the door, basically, and cancelled pre-approvals and said no more low deposit lending for the moment. That will eventually change. They're still doing it for new builds. It will change, but for the moment, that's gone. The third element is that banks are experimenting with DTIs, debt to income ratios. The Reserve Bank is going to introduce these eventually. Maybe it's a year from now. The banks want to make sure their systems are ready. It's sort of just a bit of bad luck. They're doing that third thing at the same time as we've got the LVR changes, the CCCFA changes as well. Those 3 things, along with the interest rates going up, and also an element of what we saw this time last year, a lot of frustrated buyers. They're just tired. They've been going to auctions and failing. They've been paying money for property assessments, and they'll look forward to summer break, and they're stepping back. But it's those other things that are really in play at the moment, and the market has gone on hold for a wee bit.
Yeah, and look, as we call it in the industry, and it's been kind of coined in the media, CCCFA, which is the amendments to the legislation that you discussed before. As an organisation, we have to act that out for our lenders. And what we're finding, because of what we already do and the process we use with our clients, it's kind of a bit of a slightly more in-depth version of that. So we are probably, as an organisation, a little more well-placed than most, because we have a tool called Debt Nav that you put all your budget expenses into. So we probably a little bit further ahead, but one of the challenges for us is it is still even a little bit more involved. And then if a client wants a simple top up, there's a bit more, it's like a full mortgage application. So if you are one of our clients and you are getting a top up, we understand it's a little frustrating, and our people are, we're really working to make it as simple as possible for the clients, but we're all learning as well. And so we're trying to kind of help our clients on that journey as well. But it is a very new piece of legislation. That said, we're still experiencing volume. And really some really good quality applications as well from people who are, repurchasing or moving on and still traipsing through. And a wise person I know always says, you've just got to keep moving through your plan and making the right decisions as best you can and get the right advice. So I think that's still happening as well. With this in mind, the growth rate seems to be, are you seeing a flattening or a falling? Because you are the magician that I always refer to.
Yeah. I'm not going to claim too much predictionability. Nobody has got a good record on house prices for a few decades, I would suggest, in New Zealand. But I like to try and, I guess, take a bit of a balanced view. And having been around for a few house price cycles, I know, I get a feel for what happens when the market flattens out. Some people will over extrapolate it. They'll say, all these people that pay paid too much. They're about to get their comeuppance by house prices falling away. I'm not quite so sure. I do believe in some parts of the country there's possibly some over construction, and that's going to work its way through over the next 2 to 3 years. But in my Tony's View weekly publication for December the 2nd, people can go to my website and find that, I list 17 reasons, 17, why the housing market either has flattened out or is going to be flattish for 2022-23. But I also list about 19 reasons why there is still some support for the market, why there in fact will be some new buyers coming back into the market. So it doesn't add up to my point of view of things are going to be falling away, especially not when we've got the unemployment rate in New Zealand at 3.4% and set to go lower, when you have a strong labour market that is very strongly supportive of the housing activity, the turnover in New Zealand, and also of the prices. And I think one key point to note here, in fact, two key points. Number one, ever since a week after March 23, when the tax changes were announced by the Finance Minister, I've been saying investors had better hope that by the time we get to February 2022, house price inflation has slowed below 10%, because if it hasn't, a majority Labor government could easily go and introduce some more anti-investor tax changes out there. The pressure for them to do so, I think, is evaporating at the moment as the next few months will show house price inflation slowing down. The best news I'd suggest is for first home buyers. Listings are already improving, and I think they're going to improve quite a bit more over the next 3 to 6 months. A lot of vendors who've been holding out for high prices are now going to get more realistic. Some of the vendors who've been unwilling to sell because they're not confident of buying, once they see the listings going up, they'll realise I probably will be able to buy again, therefore I will sell. So that dynamic, I think, that's been so much of a problem for first home buyers is going to be shifting to a certain extent. So I'm looking forward to more listings coming forward over the next few months.
Do you see these changes impacting interest rates next year? Because obviously they predicted 7 increases in interest rates. Would this give our Reserve Bank Governor thought to pause or not?
Not. This is something I described as a red herring back over 2006, 2007, when the Reserve Bank was fairly slowly, too slowly, raising interest rates. Mortgage rates were only rising gradually. House prices in New Zealand started falling from about July of 2007, but the Reserve Bank kept raising interest rates because their target back then and now has not been house prices. Their target is overall inflation in the economy, currently 4.9%. They see it going to 5.7%. And in order to slow down the rate of inflation in the economy, they need the economy to slow down. How do they get the economy to slow down? Principally, they want you and I as consumers to ease back on buying cars, fridges, couches, going down to the corner dairy, the restaurants, the bars, all these sort of things. So what they need slowing down is consumer spending, not house prices. House prices do feed into driving our spending, but not as much necessarily as people think. And my concern there is that the Reserve Bank is still going to need these interest rates going up quite a way before we feel, oh, I'm worried, I'm going to pull back on my spending. Why would I be worried when my job security is potentially the highest it has ever been? Why would I worry about, maybe losing a bit of my wealth if the value of New Zealand's housing stock has increased $400 billion over a 2-year period? There's a lot of insulating factors for the Reserve Bank to push back against. So I think people should reasonably assume that the Reserve Bank will continue with the interest rate increases that they have planned. And what does that mean for mortgage rates? It means maybe for the 3 to 5 year terms, they could rise up to another 1% from where they sit at the moment. I'm thinking that's the maximum. For the shorter term interest rates, they're more closely tied to where the Reserve Bank's official cash rate is right now, as opposed to 2 years' time. Maybe there's up to 2% increase left in the 1 year fixed mortgage rate. So still some further increases, but the bulk of the increase for the longer term rates has already happened. I still have a good outlook for our economy, which means the Reserve Bank, it probably has the same good outlook by and large, which is another reason why they're still probably going to push interest rates up a little bit further, because in some regards the outlook for the economy is too good, considering our shortage of machinery, shortage of people, shortage of raw materials.
So using a simple traffic light framework, would you define your economic outlook red, orange or green?
Oh, I'd give it orange greeny, I guess.
You didn't actually have that option, but I'll allow it.
It's oscillating. It's luffing between the two of them. Okay, let's start with green, but the Reserve Bank needs to slow it down to orange because our economy is growing too fast. That's where we're getting inflation, not just overseas materials increasing in price, the petrol price, etc. The Reserve Bank has already said the level of employment in the economy is above, it's beyond the sustainable level. We are going to get some version of a wage price spiral next year, and we are going to get businesses putting up their selling prices even further. So the Reserve Bank does have a job on its hand with regards to pushing interest rates up. And at some stage, central banks always look to scare people a bit. It'll find the interest rates can only go so far. At some point, it will need people to think, oh my goodness, they could raise interest rates another 2%. I've got to pull back and not buy the couch. That's actually a weapon the Reserve Bank can use. And at some stage, I think late next year, they'll pull that one out of the drawer, but not for a while yet.
It feels like we're starting to see a lot more cautionary messages. The New Zealand initiative, are quite concerned around global financial system and public debt levels. Debt not backed by assets is pain deferred. I'm quoting them here. And we're starting to see a little bit of media hype around recession, depression, all that kind of stuff. So Tony and I wanted to take some time around this today and give a slightly more balanced view. And I think being very optimistic with your green. So tell us about the orange side. So what's the risk factor? It's a balanced view, isn't it?
For me, the biggest risk isn't, let's say, Omicron or whatever comes along after that, of the borders not opening as soon as we expect, because that stuff's sort of already in place. For me, the biggest risk facing our economy, it's not the commodity prices, which is easily one could look at. It's also not the global financial system or debt levels, etc. New Zealand's government debt levels are exceedingly low by world standards, and there is not a single credit rating agency overseas or an international fund manager at all concerned about New Zealand's debt levels when they look at the United Kingdom, France, Germany, United States, etc. Italy, yeah, exactly. My biggest concern is inflation. My biggest concern is there is let's give it a small chance, the Reserve Bank will have to do what they did in 2008. They threw the economy into recession in order to get inflation under control. People often talk about during the GFC, the global financial crisis in New Zealand, house prices fell. They fell by about 11%, and then the conversation moves on. Actually, New Zealand's house prices fell about 9% when we were in the recession created by the Reserve Bank through high interest rates, and they only fell about another 2% when the GFC got rolling from September, October of 2008. And so if we don't get inflationary pressures in New Zealand under control relatively quickly, the Reserve Bank will hit until they are confident inflation really will go back towards about 2%. So for me, that's the biggest risk. I'd only give a small probability to the Reserve Bank having to create a recession through exceedingly high interest rates. And if they do, it's more like 2 years down the track. It's not going to be something immediate.
We're talking about these macroeconomic factors, but what can we do as our humans to kind of, everyday Kiwis figure out, to map our course through what could or couldn't come our way?
You recognise the uncertainty out there. Much as I have a view, I'm also aware of the many uncertainties and things unknowns, as it were, that could come along. And so you take, I guess, a prudent approach to managing your interest rate risk. And that's why not only have I been a big fan of, let's just say, fixing 5 years around the 3% and leaving it. Well, that's gone. You'd pay about 5% now. But have a look at a number of terms, maybe a bit at 2 years, a bit at 3 years, maybe a bit still at 1 year fixed mortgage rate. So you spread your risk there. And also maybe from a property investor's point of view, so this is something potentially positive for first home buyers, etc. Many investors have now got very unbalanced portfolios. They are planning for their retirement, but now a lot of their retirement wealth is in the form of residential investment property. They need to diversify. And so that's one reason I've got a new survey set up asking people about, are you going to buy shares and cryptos and precious metals, that sort of thing. And I think for some of those investors, they'll go, we've done really well with the property. Let's now sell the property and we will spread that money over maybe an international managed funds portfolio. That's something I think is going to happen in New Zealand in the next 2 to 3 years. And that, again, is going to be good for listings slowly over this period of time. So, you don't put all your eggs in one basket. You acknowledge that at any stage, frankly, we could still go into another lockdown. And so you manage your business by looking to keep good supplies of raw materials on hand. Well, everyone around the world knows that now. And keep in contact with your bank. And I just want to finish this little section with a little warning here. There's many people who are new into the property development sector, and they're a bit undercapitalized, they're inexperienced, and they are they're over-optimistic about the ability of their bank to keep financing them through when they're racking up bills for wages, for the materials, paying council fees, etc. When you have a boom, there's always some operators get weeded out, and that will be the case in the residential construction sector. So to anybody listening, looking at this out there, and you're looking at getting a new property built, make sure you fully understand the longevity of the person that you're contracting with, and be careful maybe about some of the sums you're paying along the way, and definitely have a lawyer go through the legal contract with you there for completion, sunset clauses. You definitely want to pay that extra advice for the lawyer to go and get that done.
A lot of our advisors are talking with clients about keeping their debt nav and their budgeting up to date and just monitoring that spending. We don't want to be contributing to too much inflation.
No, exactly. That's right. Keep it under control. Because if you're looking to get a mortgage these days, your lender will certainly be asking you to get it under control. So, it's a different lending environment, and listen to your advisor. They're in a good space, I think, in terms of providing that information that people need now.
I did just want to touch on Auckland and this lockdown and COVID, because it just seems weird. We're talking about all these quite optimistic underlying economic factors, and we've been in lockdown and probably with more to come at a very switch on, switch off, manage it basis. We don't know what's coming next year. It doesn't necessarily mean that the different strains, but as people get sick, we haven't seen mass sickness in this country yet, and we've got businesses coming out of lockdown in Auckland who have, let's be honest, been severely affected. So it's all well and good for us to talk about wage growth and optimism, but how does that wash through our economy? Do they just open their doors and go for it again? I mean, it just seems remarkable.
Yeah, it's a good point in that as an economist, I'm expressing a good outlook for the economy based on the traditional big drivers of economic growth in New Zealand, the export receipts, the consumer spending, construction, business investment, and even government spending as well. All of these things are sort of on the driving growth side. That doesn't mean at all I think this is going to be some sort of generous operating environment for businesses. And when I'm giving webinars towards business audiences, the way I'm talking about it all the time is this. Traditionally in New Zealand, we've concentrated on marketing, advertising, acquire customers, more customers on this side. Then I go and look to hire staff, find the premises, get the materials, and get the finance from the bank. But we have become a capacity constrained economy. And if you run your business that way these days, you go and sign up all these contracts, you've got to supply these outputs, then try and find the resources, you're going to come badly unstuck because the people aren't available, the supply chains aren't in place, the banks are pretty cautious on things these days. And basically, you need to be doing things the other way around. Figure out what resources can I command for the next few years? The people, how do I hire new people, train them up? How do I retain my existing staff? How much finance will the bank provide me along the way, etc.? And then figure out what sort of output level will that allow me to achieve. And the answer for some businesses when they do this exercise is, I cannot even sustain my current level of output without hiring people whose quality is so bad that I have to redo the job and there's the profit gone. So I guess that's the way I frame this. My outlook for the economy, for the demand side, is good. That's not the issue any longer these days. It's this side of the equation. And unfortunately, let me just finish with one other comment here. If you think it's tough on the labour market sourcing people at the moment, you still ain't seeing nothing yet, because I feel that once things have settled down a bit, the borders are sort of properly open, we're going to have a lot of young people move to Australia for higher wages, lower house prices, greater range of houses to choose from, lower cost of living, and just to experience a bit of being overseas, quite frankly, as well. So you better pay a lot of close attention to management and retention of your staff. Figure out what it is they want. And it's not always money, just for your guide. It could just be recognition and fish and chips on a Friday.
It's a really good point, because we talk about a lot of these macro factors, but I'm conscious, and we are a company of small business owners as well. And it's been, we're in a booming sector, we have been, but it's been hard on them too. And I think it's been hard on our country, to be honest. But yeah, I hope that the businesses opening their doors across the country are in for some stable trading, I'll put it that way.
That'd be nice.
Okay, the tourism sector, it's not, my understanding is the take on that is it's really going to be VFR, which they define as visiting friends and relatives for the first stage, because you've still got to isolate. So, and we are still a far-flung destination to get on a plane and come to. So it's gonna stay tough for tourism. Is any insights there, Tony?
I guess the interesting dynamic I would look at is this. If you look at the likes of Queenstown, some of the other sort of holiday destinations in New Zealand, even though they've been weak because of the absence of the foreign tourists, the real estate markets got themselves vibrant again very quickly, and significantly because a lot of Aucklanders are wanting holiday homes in New Zealand, and I guess Wellingtonians, etc., as well. And also I think because a lot of people have advanced by a few years their retirement or lifestyle change plans. Why would I wait 3 to 4 years to sell some of my assets up in Auckland and move down to Wanaka or whatever, when the price of my investment properties has just gone through the roof? We've achieved our wealth goals 9 months ago, or we could be struck by COVID. Let's go and make the change now. That's interesting. Some of the property transactions which were going to occur next year, 2023, 2024, they've actually already happened, or they're still going to happen, in the next few months. And here, while I have a view of the property markets generally flattening out, I still have a very positive view on the likes of Northland. Lots of Aucklanders are still wanting to shift up there. In Hawke's Bay, I think it's still got some momentum as well, elements of Bay of Plenty, Tauranga, and of course down the Queenstown Lakes District as well. That ball is still rolling. So in a lot of my analysis now, I'm trying to focus a bit more on what will be some interesting regional disparities. Christchurch has still got catch up to do. Auckland is not overvalued. This isn't 2016 when Auckland was well above, everyone else. And so there's a bit of a difference there. Wellington, it's highly priced, shall I generously say, at the moment, and say no more.
No, understood. I do want to say a special thank you, Tony, for a lovely year, and it's been great working with you, and we're looking forward to refreshing tea with Tony next year, and also, so we'll probably start again in January, February. Tony and I will work that through, and our in-region program will kick off with Tony again, so it's more of a regional take in person next year, hopefully. Hopefully. So we're really enjoying working with Tony, and we're starting to get really good cut through with Tea with Tony and great feedback. So please do send your questions in, and have a lovely Christmas, Tony, and everyone out there. As I always say, Tony's views are his own and not representative of NZHL, and vice versa, and we like it that way. He's an independent economist, and we're very lucky to work with him. So Merry Christmas, everyone. See you later.
See you later. Bye-bye.